We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Hey, this is Tom. If you've found value in these interviews over the years, please don't forget to like and subscribe to the channel, especially on YouTube. I don't like to interrupt the show to do this, but it helps our channel to be seen, which has proven to be more and more difficult on certain platforms. Thanks. Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Peter Goodburn, founding partner of WaveTrack International. Peter, thanks for joining me today. How are you?
Great, Tom. Thanks very much for inviting me. It's great to see you.
Great to see you too. It's always a pleasure to get to speak with you and really dive into how you see the world, how you analyze markets. And you focus very much on Elliott Wave analysis. So that being considered, what do you think are the biggest things we need to be taking into consideration right now?
Well, there's a couple of things. Of course, most of the financial markets are spinning around this whole narrative of Trump and tariffs. And from what I can see, looking at the association between sort of two distinct asset classes, that's stock markets and gold, we get a picture of being fairly binary in terms of the tariffs and the way they relate to the market movements. Of course, if the tariffs and the wars going on between particularly China now coming into the fold, if they basically continue to exist, stock markets go down, gold goes up. And vice versa. Of course, if things start to cool off and we start seeing some negotiations coming through from China, from the EU, the stock market will likely sort of turn around, head up, and gold will go through a series of profit-taking sell-offs, and that which could last several months. So it's fairly binary. I think these are the two main aspects. Of course, we can fold interest rates in a bit later if we have time to have a look. I can say now that from overall the interest rate spectre, there's been a lot of discussion, of course, about stagflation. So that means interest rates and prices or interest rates going up, prices basically sort of folding lower. But overall, when we take a look at sort of things like Treasury yields, we get the distinct impression that Treasury yields are heading lower quite a big way over the next several months, which in itself does seem to convey the idea that at some point the US will go through downturn. That's one aspect which can to the general. Mm-hmm. But I suppose overall, when we take a look at some of the biggest moves that we've seen just recently, most people would be probably more exposed to the way the stock markets behave with the sell-off that we saw last month, and in which gold has shot up into new record highs. Maybe we could have a look at some charts. What do you think?
Absolutely.
There was a couple of things which I thought we could kick off with and really just have a look at some of the movements in the S&P and the Nasdaq, because this is a chart that we produced in the annual report, which we published at the end of December last year, mm-hmm. which showed that the S&P would have a 20% decline this year. We were sort of tucking in around 6127.5 at the time. And we forecast down to 4,900, this sort of area down here, before we start heading up again. And if we take a look at what's actually happened, you can see that we've come down all the way, slightly exceeded 49.07. We got to 48.71, but straight back up above 5,500 cents. The interesting thing about this is that the sentiment indices and technical sentiment indicators were all extremely oversold at the time. This is CNN's Fear and Greed Index. It was down at 4%. The last time we saw that was actually back here in October 22, when the S&P 500 was down at 3502. Mm-hmm. It was, of course, a major low that resulted in all of this move that unfolded afterwards. So we do know that this downside target that we had from last year hit price levels pretty accurately. And since then, we've been turning up. Also, you can see that from some of the technical indicators, this is a daily S&P technical indicator. The stochastic that hit lows last month, this month, and so did the RSI. And the weekly also has now hit a lows, both of those technical terms. So in principle, when we take a look at that, that would normally be quite bullish now. And yet here we are with the markets in transient point recovery. Whilst that's going on, of course, a lot of the big Wall Street banks have slashed their targets for the main US indices over the last weeks. And that's because they were obviously putting in very bullish forecasts earlier. There's one caveat for those tuning in who are probably a little bit Elliott Wave theme, is that the decline, in order to make a major low down at this 4830 number, we did need not just the Fibonacci price levels to be hit, which they were, but pattern decline from December had to be 5 waves down. Well, we got 5 waves down in principle. The concluding 5th wave, down from 58.37, that should have unfolded into 5 subwaves as well. So it's a fractal 5-wave subdivision. Mm-hmm. But we only detected 3 waves into that low. And that's a little bit troublesome because ordinarily that could mean it's possible that finish to the downside. It's a little bit strange. If we wanted to basically vindicate that 5-wave decline, we'd have to go through what's called a truncation, which was the secondary low at 48.71 3/4. But truncations are pretty rare. They can, of course, occur when there's a bit of panic in the short term, which, of course, was accompanied to the sell-off weeks ago when we did see a number. But to be absolutely 100% conviction about where the direction is coming from, we can't really give that just yet until we've seen a little bit more data build. In this chart, again, another example in the inset left chart is from Mark Hulbert. He does a sentiment index. That was actually very, very low at the time. And it was, again, repeating what was the lows back in October 22. It was extremely low. That was another indication that we could have seen a low. The big question that we ask ourselves at the moment, whilst we're watching how the short-term build-up occurs, is in order to answer the question, have we had a major low, contrary to Wall Street's revisions to the downside, and certainly contrary to general consensus opinion that the market's going to head down further, is the fact that only seen 3-wave rallies so far. And if the market breaks the lows, what would it look like if the market broke the lows? And this is the Elliott Wave solution, because a lower low would trade down to about 45.74 in the form of a diagonal from this 58.37 high. And the diagonal is a sort of a wedge-shaped pattern. It gives us confirmation that this is a terminal phase of the decline, which is always good to know, because obviously the lower prices go down, the more bearish people get, and they start thinking of then Armageddon, which is basically a collapse of proportions not seen since perhaps the Great Depression or something like that, or maybe even the financial crisis sell-off in 2008 and 9. They start thinking like that. But this would be that it's in a terminal low and not something that would ultimately collapse and accelerate. So that's quite useful information. The other aspect to it is that the diagonal, an ending diagonal, is consistent with 3-wave activity to the downside, which this has to the 48.32 low. So this is one equation which could resolve the matter. So again, if we're talking about sort of movements being fairly binary to the tariff news flow, yeah, I'm afraid we're basically going to have to just keep our ear to the ground and be aware that we could have hit a major low basis the technical price levels, certainly the oversold conditions that's coming up on the technicals. But from an Elliott perspective, to understand that we could see marginal lower lows before we start getting the big turnaround. But we're not really looking at an ongoing bear market that will last longer than, say, the midsummer this year, summer northern hemisphere. We're not really looking at something which is going to collapse lower. We're ultimately looking at areas to buy, because after this decline has completed, we're seeing the build-up of a new bull market, which takes us into new record highs. And if we move ahead to something like the Nasdaq, you'll see the same pattern similar to what we looked at just now on the S&P. Here's the track record from December. We talked about major decline. This was actually a more like a 30% decline, getting down to 15,500 that we saw in December at 22.5. And this is basically what's happened since. So we've achieved the price targets, but again, there might be a little bit of a question mark over whether or not we've actually seen a low or not. So within the next week or two, for sure. But in terms of repositioning to the long side, we haven't done that yet because we're just waiting for the confirmation. Another confirmatory signal comes from Bank of America's latest survey. And they've got here that you can see that the record number of global investors intending to cut US equities, very, very low indeed. So, yeah, this is basically, well, actually, it's very high. It's actually increased as the market declines. So they're looking at cutting their long portfolios. And you can see that's gone into a negative reading. That means that, of course, contrarianly, that's quite bullish. And again, we don't know if we've got this is going to break higher or actually trade lower. The key point for the moment is 20,536, but I'm expecting to make much earlier this because this is really quite far away. But I think we just need to watch the news flows. If we did break the lows, we've got the same diagonal pattern as we saw before in the S&P, where this trades down to about 14.75, 14,785, around that area, and then goes up into new record highs. So I think the take home from this is that basis what we first published in December, those declines have worked out very well, but we're trying to fine tune a little bit to decide whether or not the low occurred in early April, or whether or not we're going to sort of slip down a little bit lower. But again, it's fairly binary, I think.
Well, Peter, in that way that you're kind of analyzing this about, not having a dramatic downside waterfall event yet, and you're saying that this goes up to new highs very likely, does that kind of lend itself to this idea of a possible blow off top for another crash type event? And obviously we would need to see somewhat of a major print from many governments, but especially, we're talking US markets, so US government alongside that, or that does cause that.
Well, I think there will be another downturn at some point, which could be, much larger than this one. This is the Nasdaq on a weekly chart. And this shows the expectancy of this drop down to these numbers. But after that, we managed to scratch into new highs once we've verified this low. And this is purely, actually, this pattern is actually a diagonal. It's an expanding type diagonal. Maybe I could show you what that looks like for those of you tuning in who are probably not so Elliott Wave affine. But the pattern should become apparent if I show it to you. So this is the sort of pattern that I'm expecting. I'm going to put in a few ratios as well. And we'll see if this looks familiar. So this is the sort of pattern that we're expecting that began from the pandemic low. Pandemic low is here, 67.71 on the Nasdaq.
Mhm.
And you can see it's sort of like an opening gramophone. We call it an expanding diagonal. But so I know some technicians would say this is a sort of gramophone effect. The old gramophone where it's sort of the speaker is up here. And if you take the first move up from the post-pandemic low to this high in November 21, that's wave one, which is basically here on the tutorial chart. Back in wave two, wave three is consisting of three price swings: up, correction, and up again. Up, correction, up again. We're just in the correction to that first swing up, which topped out in July 24. And so we need to trade up to at least 26,000, I would say, verified this current low. But after that, we're going to get a bigger correction. And that sort of chimes in with what your question was, really, because that one could be quite troublesome. You know, it's much bigger than the ones we've had before. And before we go up into one final sequence, which is the fifth wave, 32,000. There's a lot more here, but of course, when you look at this particular pattern, there's a lot of volatility as well, isn't there? And this may take another 2-3 years to manifest to a completion, 32,000 or so. But ultimately, this means a lot of volatility, price swings. It's not like the intermediate third wave uptrend, which began from the financial crisis lows and started moving up in a very straightforward, straight line. Year after year, we saw good gains, jerking activity, up sort of to new highs, and then suddenly we're crashing down again suddenly. So we're going to get a lot of volatility here, and that's just a symptom of this particular pattern. But this is not just isolated to the Nasdaq. We've got the same pattern unfolding for the Dow Jones Industrials, the same for the S&P 500, and even for the Russell 2000. So all of these are unfolding into the same diagonal patterns that we've seen. But it does mean, a lot of volatility ahead.
Well, Peter, one of the pieces of your report that I found really interesting is this idea that in a recent Bank of America survey, that global recession fears are actually at a 3-year low. And, this seems very much in contrast to many of the other conversations I've had recently. But this idea of basically the rotation of capital and selling out of the US markets has to go somewhere. Does that end up feeding more capital to the rest of the world, particularly Europe and China?
Well, we have seen a very, very big push prior to this late March into April's lows. We've seen capital flows very much push across from the US to Europe and China. And of course, this was obviously before the big sell-off that we've just encountered. And we did put out a note in this report, which is a Gator report from around mid-March. And we did say that these capital flows, although they're existing at the moment, they might start to dry up again. And that's certainly been the case in the follow-up in the April of this survey from Bank of America. But they did quite rightly show that there was huge capital coming out of US stocks and going into this. They considered that Europe was relatively inexpensive. Earnings per shares were lower. And that gave them scope for huge gains. Most of the gains, though, were in two sectors actually in Europe. One was the stock called SAP. You may have heard of them. They're one of the largest IT innovators in Europe. Another one was basically Rheinmetall, which was this building tanks in Germany. It's a defense stock, basically. And of course, the German government plus the EU as a whole recently put through a stimulus package to try and replace infrastructure spending, but mostly most of that is really going into defense. because the US, through Trump's administration, wants to pull out from its funding, and the EU is saying, right, well, we'll have to step in and meet the gap that's created. So yes, there is a huge amount of money being switched across. From what we can see, the sell-off at the end of March into April been so quick. Most of the big asset managers that we speak to haven't yet changed their portfolios around. They did much in Europe at all. So they still maintain those positionings, and the cash levels haven't really gone up at all much. But that may change in terms of China, because although to a lesser extent China was one of the hubs to attract funds, when we take a look at certain indices like the Hang Seng and the Shanghai Composite, well, the Shanghai Composite hasn't actually done very much since the post-stimulus announcement. The stimulus announcement occurred here, where I'm pointing to on this Shanghai Composite chart, and it sort of rallied from last September up into the October highs, but it simply met some overhead resistance and dropped down since. It's not really displaying anything dramatic to the upside. Besides which, preceding movement up from October 22 and this low here from February 24, this movement up, they're all basically corrective patterns, which implies that there's still more downside risk. I think the downside risk that I can see is much more clearly evident examining what's happening in the Hang Seng Index, where this decline from 2018, this goes back to January 2018, this decline is an expanding diagonal. It's the inversion we saw before with weekly Nasdaq, this pattern. It's an inversion of this, it's just upside down. Actually trend this like this. Yeah, it's like this. And we've actually just recently, in the sort of stimulus program took us up into sort of March 25, which is basically here. And this is basically heading down. We've seen a good reversal signature from that March high. It's trying to fill the gap a little bit at the moment. But I think that this is a very clear picture, in my view, that this is actually heading down sort of something closer to 12,000. And that, to me, of course, in that context, helps us to interpret what the tariff dialogue will be between Trump's administration and China. Of course, Trump has said, well, if China wants to negotiate, they should call me. And China have retorted by saying, well, we are prepared to sort of contact you, Mr. Trump, but we have some preset conditions, and one of them, the top of our list, is respect. The Chinese, in that context, put respect above everything else. There, people can negotiate. And of course, maybe respect is not in Trump's agenda at the moment. So maybe that suggests that these tariff problems are going to continue with China, and that ultimately may cause this, saying maybe the trigger point for this Hang Seng to trade down to 12,000. But once we do see those capital flows dispersed properly, I think we can see. I mean, obviously there will be damage for China in this interim period, but we're not quite seeing the same effect in Europe. In a way, a very similar condition in Europe is occurring, because Europe could actually be posting in a low pretty soon. There's still a risk that we come down one more time. Basically, Europe then would start to show a buy signal. So it doesn't have the same sort of downside risk that China's showing at the moment. And so the fund managers that have been repositioning their portfolios and pushing across into Europe, they would obviously maintain their positioning, and I think that they were probably right to hold on to their positions at the moment. But the basis of the original sort of analysis that we put out in March was that that the markets would start to crash down, And we could see this in some of the surveys that Bank of America was putting out. I mean, most crowded trades ahead of that time was still long Magnificent Seven and long EU stocks, which is the first time that that's appeared many, many years, actually. That was the real reason why we said that the markets would undergo a fairly strong decline onwards. If that's answering your question, I hope so, because it should clarify why behaving as they were at the time and how they've readjusted themselves and where they're going to now down the road.
Well, I think looking at something that might corroborate that evidence is this idea of copper. You know, we've heard many times that copper is kind of a barometer for the health of the economy here. So obviously going into or in preparation for the tariffs, copper spiked up over $5 and then, or I guess $5 a pound, I don't know what that ends up translating to, has since pulled back and regained a bunch of that strength. So how do you see the copper picture going forward here?
Well, I've got a copper chart here. This is a weekly chart. And of course, we did see a lot of London Metal Exchange. This is dollars per ton on the LME. I prefer to do the LME mainly because it's a 3-month deferred contract without any gaps of rolling futures positioning, which can upset the pattern. So this is in a way a better benchmark for doing the analysis. At least you can always translate dollars per ton into cents per pound by dividing by 2204.62. This is what we used to use in our arbitrage calculations when I was working for the LME brokers back in the late 70s. But we have some distinctions to make because LME copper never traded above $5 a pound recently. Because of the arbitrage, basically all the copper was going to the US in anticipation of more tariffs. And this is a bit like the gold bullion market, where we started to see London bullion vaults open up, send bullion basically to Switzerland, where these 12.5 kilogram bars being melted down into 1 kilograms so that they could be delivered onto the COMEX exchange in New York and shipped out. So that's basically what's happened to copper as well. We've seen a lot of copper going out of LME warehouses to New York, where the premiums were making us above $5. That's about $11,000 a ton. But that didn't happen recently. The highest copper got to on the London Metal Exchange here was 10,164. So I'm just doing my calculator, 204.60. So that was about $4.6 a pound.
I was going to say, Peter, it's a little beyond my mental math capability here, you know, right at the moment to be able to do that.
Yeah, no, I should have impressed you better without referring to my calculator. But yeah, but you know, since then, actually, it's dropped down from that high, 10,164. It's traded down $2,000 to 8,100. That's very consistent with a continued process down, where I think we can get down to 7,000. So that
kind of into next year, then.
Maybe into the first quarter of next year, yeah. Mm-hmm. If I divide that by 2204.62, that would be about $3.18 a pound, $3.18, something like that. That's US. Mm-hmm. So, yeah, we could get down to those sort of numbers. I'd like to see that before buying copper. Before this recent sell-off, though, of course, we did see a lot of the investment banks starting to talk copper up. Particularly, we have basically all of those reports, and there was a lot of them coming out at the time trying to buy copper, which upside forecast. They've all stopped. I mean, the jungle drums for copper has basically stopped entirely since it's dropped $2,000 a ton. And that's not surprising, but it just goes to show you've got to be so very careful about sentiment and reading into extremes. And I don't know a better way than Elliott Wave to really show us when those extremes occur. Mm-hmm. Because if we start to get sentiment extremes at points inflection, like copper was doing just before the sell-off in the stock market, and where copper dropped $2,000 a ton. I mean, this is really a very, very important information, and I can't stress it enough. And I don't know another tool that can give you specific downside targets as well. But it's worked out very well. I think there's going to be more downside on copper before we turn around. But the interesting thing about copper is, of course, it's tied into the China story, isn't it?
Well, I was going to say, this seems to be in contrast to an idea that China and Europe basically making up the greater world economy, or taking those pieces into consideration, that there's, not this global recession headed for us.
Yeah, I think that the fund managers got a bit too carried away with China and buying Europe, and obviously we've traded down since. But they'll hold on to their positioning. I'm not so worried about Europe going down too much more, if at all. But Hong Kong and China look vulnerable to me, and I think that's certainly consistent with the Hang Seng numbers that we just looked at. Is consistent with copper getting down to sort of 318 a pound, or 66.82 as shown here on the graph, dollars per ton. But I think that's a consistent theme that we're seeing, really. If we're looking at copper as a sort of conduit to what does China look like, and then I think those two asset classes look the same to me. They corroborate to the downside, yeah.
Well, one of the other ideas that China has been at least announcing is this idea of kind of holding back the strategic or rare earth metals. So how does that availability and price look and affect, or how does the limiting of those metals end up affecting the price going forward here?
Well, as in normal factors, if you're going to see a shortage of something, the price goes up. It's fairly easy to estimate. I mean, this is MP Materials, which has been a quite extraordinary price level. The MP Materials is a US-based company. You can trade it on one of the exchanges and in the US, and it's probably has the most exposure to rare earths. And if China are going to start limiting their process, then certainly MP Materials share price will go up, and it has gone up. Even before this news story that broke the week before, where Trump sort of said, well, we're going to start putting this into the strategic reserve, and we should be starting to explore areas even offshore, which would translate into us finding independence on some of the rare earths. But MP Materials is there. It's been operating for some time. What I found quite extraordinary was the decline from $60 up here. This is March 22. In fact, that was ironically the top in oil prices at the time. And we traded all the way down to a bottom here. So this was August last year. So we've gone from 60 to 10. And I mean, actually, we did put a buy recommendation out for our clients at the time down here, simply because we've gone back to the origin points where this traded. And it's since traded up very nicely indeed. And we're very bullish for this longer term. I mean, I think we can go up towards 100. In the short term, we're probably looking at a little bit of a correction down to 21 or something like that. But then again, this stock is looking very, very bullish. And if you did see a bit of a correction over the next month, try and buy into it, because this has got a very good future. And I think this is a very good exposure. MP Materials has done very well so far.
Well, we kind of went over this idea of the tariffs really affecting the demand for copper going up. And then, once we had a little bit more visibility on what the tariffs were going to be, it obviously pulled back. Gold did much of the same. So if we could go over the gold chart and kind of understand why gold has had a lot more strength rather than copper in that way, or in that same.
Yeah, well, I think, copper being an industrial metal, of course, copper did go up originally, but then it sort of set back mainly because we do know that tariffs means less production, and feeding through into the end usage of things. And so, of course, that's why copper really sold off. But gold is a different animal. It's an alternative to money, and gold has basically gone through the roof. Let's have a look at. I'm just going to pull up something on. Just check here. Yeah, this is a gold chart, and this particular one was published on January 14th this year, and the time was 26.89, and its long-term effect from basically going back to the Great Depression lows was still building its way up in a concluding fifth wave, which began from this 1998, 1999 low at 254. And we've applied just a very specific fib price ratios here. We've extended is 1 through to 4, so from $17 to 254. We've extended that by 100% to get to 36.50, around that sort of area. And then we've taken the subdivision of 5 waves from 254, this fifth wave, and we've taken a 61.8 correlative ratio of 1 to 3 for wave 5, and that comes at 38.20. So that's a viable upside target, but that's sort of a normalized limit. Here is the monthly chart, from the same January date, and you can see that there's a slightly lower target at 36.75 coming in, but generally speaking, that would be a normalized upside target. Now, the interesting thing is that with gold is that China is really a big buyer. It's really quite a big buyer of gold at the moment, and it's driving the movement up, mainly because of the anticipation of tariffs and so on. And I've got a little chart to show you, which I published at the weekend. I'm just going to pull it up, and it actually shows how China's exchanges have been buying. This is from Bloomberg, and it shows the inflows gold ETFs in China going exponential at the moment. We've not seen that for a long time. But you can see also we've got a relative spike coming through on the volume traded on the gold futures exchange in Shanghai, which I did a presentation on, I think probably 15, almost 20 years ago, this subject. And I think that gold, to a large extent, is getting a little bit overheated because the investment banks, again, are in a situation where they're upping their gold targets. The further the price goes, the more they have to chase the price higher. And that's a very dangerous thing to do. They did it with those European stocks and those China stocks just before the sell-off in March. And they're doing it once again. So whenever you start to see the revisions to the upside in forecasts from the investment banks, they sort of leapfrog current price by quite a significant amount, then you know that we're getting to a terminal high. And also at the moment, the buying is really coming through from the Chinese market. I don't think that there's too many fund managers who are to this extent. It's certainly overshot some of our original numbers. Here's that old 36.75 number coming in. The actual wave pattern that shows an extended fifth wave, and this has a certain limiting upside potential. We've also seen in the latest Bank of America chart that gold is now the number one longest trade. It's overtaken the Mag 7s, which is quite interesting. So sentiment is incredibly bullish for gold, and that's a bit of a warning signal as far as I can see. Now, I've had some interim targets at 33.92, which have been hit actually today. First time. given in mind that last week we saw a sell-off down to 32.88 on gold, and here we are trading above 3,400 slightly today. And gold is, as you can see here, it's real time. It's trading at 34.15 at the moment. But we're getting into those sort of numbers where an intermediate third wave, counting up from this low back to October 22, is finishing. And it's quite an extraordinary third wave. But this gives all the signals, looking at quite a steep correction. And you can see here on a daily chart on gold, there is the 5-wave subdivision of intermediate wave 3. So we need 5 waves before we can determine the top. Here's wave 1, 2. Now there's 4 actual fib price ratio numbers on here to measure the concluding 5th wave. First one was to extend this 1 through to 4 by 61.8. Well, that came up here, 31.25. We've clearly gone through that. The next one was to do a 61.8 correlative ratio. So we measure waves 1 to 3 times 61.8 equals 5. So that equation comes to 33.14. We broke that slightly, well, Friday to today. And there's 2 more interesting numbers. If we extend 1 to 3 by 61.8, we get this exhaustion high at 36.45. I don't think we're going to go that high. In fact, I think that even today we could be looking at a top right now. But there is another number in between at 35.46, and that's derived this. If we extend is 1 through to 4%, comes to this 35.46 area. I should kindly. But the interesting thing about that is that, of course, if we then apply a retracement value, I hope this is not too technical, but if we apply a retracement value onto that, it means that the 50% retracement back to 6, which is very deep indeed. It's not impossible for that to happen. So it's a bit of a warning that I'm saying on the gold bullion markets, because I'm a bit afraid that everybody's getting caught up in the euphoria at the moment. They're leapfrogging some of the upside targets. This is normally a little bit of a warning sign, exactly as we had with the stock markets in March, that there's going to be a downturn pretty soon.
Well, it's definitely something that we need to take into consideration, especially when things do get overheated like this, when we do just keep going up and up and up. It really seems that we need to be able to make, basically 2 steps forward, 1 step back. And when things do get overly bullish, we do need to be cautious, right?
Yeah, I think so. I mean, obviously, we have clients who are still long of gold, but I was speaking to a few this morning. They're saying, well, I'm scared up selling at the moment. And I said, why are you doing that? Because I came to the same conclusion, but I wanted to hear it from them. And they just said, well, we've never seen gold go through an exponential run up quite like this in some time. And they've also seen just how the sentiment numbers are working, and that is a very, very significant sort of signal when you start seeing sentiment get very, very high. We're now seeing in the commitment of traders, the open long positioning is extreme highs. That hasn't been seen for quite a few years. So you've got a lot of different indicators that tell you that this run up is finishing, and there's always that risk you get caught out, because you could see a $200-300 drop in just one day. And sometimes if you freeze, if you're being reactive and not proactive in your trading, when you see a drop like that, you tend to think, oh, I've missed it, and you hang on.
Right.
And that's worst of all, because then most individual traders will want to hang on to their positioning, and then before you know it, we're down just a couple of $100, but we're down sort of 500 in a month. You're sort of in trouble. So it's best to be proactive, even if you're a little bit early. You get these signs coming through, yeah.
So let's say the contrasting number to how we price gold, What does the US dollar look like right now to you, Peter? You know, there's so much on either side of that scale that really shows that it's a difficult idea to be able to really analyze at this point. But Trump basically has said that they need and want a lower dollar. So how does the dollar look as this contrast to gold right now?
Well, I think the dollar's done exceptionally well. I've been really impressed by the way in which the dollar's worked. Actually, this is a report that we did, Rise and Fall of King Dollar. And the reason why we think that the dollar is going to be turning down in a big way over the next several years. And we can see the deficits are building up and various different fundamental reasons for the dollar to decline. But from a technical point of view, we had very much signaled that the dollar would probably halve its value over the next several years. And the reason for that, if I actually put up some real-time data now, we can see that the dollar index is, just get that up here. There we go. And the dollar index is basically finishing a correction. It goes back actually to this particular point here, which is extraordinary. It's January 88. And that pattern has seen a big sideways broadening here since 1988. And it only finishes here in October, actually October 22 at 114.78. But you've seen the dollar go sideways. The precursor to that was this decline here, like this. And that has to be repeated here. So you come down, go through a broadening sideways, and then you come down again. And the measurements for that type of pattern is basically a zigzag, and extend wave A down by 38%, and we get down to 51.18. So from our analysis, the dollar is basically engaged in a huge decline that's going to halve its value. And so far, the declines that's occurred from this secondary high, and we had forecast this ahead of time in this chart here. You could see that at the time it was 107.97. It said the dollar is about to start declining very, very rapidly now. It's starting to decline. And so we have. And the acceleration down is quite significant. Now, I think that Trump originally, before he took office, was talking about sort of a dollar being strong. But I think he realizes that unless the dollar's weak and his tariff program goes through, if the dollar was too strong, we're just not going to get he's not going to get the foreign buying of American goods. So he needs a weaker dollar as well, and that's basically, I think, to a large extent, why he's also talking down interest rates, because he's got this little bit of a problem with Jerome Powell at the moment. Jerome Powell, being the official banker, has said, well, we don't know whether inflation's coming still. Core inflation, headline inflation could still pick up. Not going to cut rates again. You know what the outlook's like. Whereas Trump is saying, well, I think you should be cutting rates, and I want someone in the office who can do that for me. But that would, of course, be very bearish for the dollar, and I think it fits the Elliott pattern very, very well as we develop lower. In the very short term, for anybody tuning in that's interested in more short-term stuff, I would say that we've actually put in a low today for the dollar, a temporary low, and we're due to have a bit of a rally weeks before we come down again. These two swings are necessary to complete an entire five-wave picture, which in Elliott Wave determines trend from the January high here. But once that has been achieved, and I suspect that the completion will probably be sometime next month, after that, we need a compensatory three-wave corrective rally like this. That's going to probably last through the summer months in the Northern Hemisphere. Trade somewhere back up towards 104, somewhere up here somewhere. Trends down again later. So there's going to be some swings here, but the actual movements so far from January are very, very precise and working according to the Elliott model. And if anybody's trading currencies, I would say this is best performing asset class in terms of predictability. It's really working so well and has done for the last several years. At every major turning point in the dollar index, we've had some major success in pinpointing these numbers. And it's been really, really great. And we're doing cross correlation and different asset classes. But even when you compare the dollar index to maybe something like the euro dollar and sterling dollar, all the major G10s, so you can go through the lists from dollar, yen, and so on, we're still getting a consistent theme. The dollar is going to be a very, very weak currency going forward. And all the other currencies are going to be quite strong. The only ones that are dragging their heels a bit at the moment are the, fortunately for you, Tom, the Canadian dollar's dragging its heels a bit. It's still, unfortunately, not quite ready to join that the others have. It is trending down, which of course means US dollar weakness, Canadian dollar strength, but it's not quite as strong as some of the other G10s like euro, sterling dollar, and dollar yen, or the yen. It's a little bit weaker, and it's also very much played out with the Aussie dollar. The Aussie dollar is in the same situation. It's not quite as strong as it can be. And I think that's likely to continue until such time that we get things like copper prices bottoming. Things like iron ore as well. You know, we're not going to quite see these commodity currencies doing better than the others until such time that the commodities themselves bottom out.
Bottom out and then reverse? Is that the idea? Right. Okay.
Yeah. I mean, for example, you know, we go back to looking at, say, copper that we did before, and where, for example, if we get copper down to $318 a pound or 66, 68, 62 in dollars, this sort of area, once copper bottoms and starts to turn back up to resume its uptrend, so then we begin the next uptrend like this. And those commodity currencies will start to outperform within the peer group, the G10 peer group. But they're not really outperforming at the moment. In fact, they're underperforming. Canadian dollar, Aussie dollar, they're underperforming at the moment. And that's just because, you know, the commodities are under wraps.
Well, and, you know, I think there's other things to take into consideration, especially with the Canadian dollar. You know, politically, there's a lot that leaves to be desired, and we're facing an election here by the end of the month, and we'll see, I guess, based on the outcome of that election, what our exports of natural resources and metals are actually going to look like. Yeah.
Well, I mean, Canada has been one country which has cut its interest rates quite aggressively recently, where some of the others have held back a bit. That's obviously undermined some of the 10-year yields and 2-year yields that we track in Canada as well. But overall, yeah, once the election's gone through, you'll probably start to see some signs. Mark Carney, who's currently holding the office, I mean, whether or not he's more conciliatory to Trump, we don't know. But it seems to me as if Mark Carney is part of the old regime, and Trump is still part of his new regime of thinking. And there's a big divide between it. You can see it also in negotiations, tariff negotiations in Europe. Europe is still basically partisan, socialistic, very much more aligned to the old Biden administration, whereas Trump is, you know, basically thrown all that out the window. So it's almost as if you've got two different factions with two different thought processes. Mark Carney is still part of the old regime as well. So it remains to be seen exactly what comes out after the election.
Well, you mentioned this idea of the Treasury markets earlier in the U.S. and there's been a lot of noise, a lot of very odd market behavior in there. Do you have any way of understanding if China was selling treasuries, or what that entire picture ends up looking like with yields spiking higher as they did?
Well, that spike higher, I think, was just a volition to the stock market, and the idea that that we could start seeing some inflation coming back through into the system. But we don't have any data to show specifically about whether China was actually selling treasuries on lock, stock, and barrel. We know that happened at the lows during the pandemic. We do know that occurred at the point, but we don't have any official data here yet. Probably to some extent irrelevant to some extent, because that data spike rally was perspective a very typical second wave corrective rally. They're usually sharp, short movements, very deep, and this traded up to actually 76% retracement of the preceding decline from January. Yield 10-year Treasury yield dropped from 480 down to 386. It then traded up to the 76% retracement zone, which they can do very quickly. But it rejected that nicely last week and came lower, which suggests to me that that was certainly a second wave correction, and the trend is now downwards. So whether or not China will through and start selling assets, we know that there's been talk about that, that they would start to protect their mineral resources, their rare earths. China will become somewhat protective. They might start selling US assets like treasuries. They might start even protecting their businesses, which are entities in China operating as US entities in China. Might start putting restrictions and all sorts of embargoes on the way in which they operate. Mm-hmm. We know that these are the tools that they might likely use if there's going to be a continued trade war. But in terms of treasury yields, the trend seems to me down. We're basically verifying that because of the 5. It's down from January 480 down to 386. And this is also consistent in Europe, because we've been comparing Europe. It's 10-year bund yields down as well. One of the things that's become very evident in the bund yields is that there's been a counter-trend rally, dates back to December 23. It's come up, pulled back, and gone up again, and it's failed to break the highs. So technically this is bearish, and it's rejected since, pulling down in the March high. And this is basically giving us a very clean signal. It's going to be declining. So I think whether it's bunds or treasuries, corrections down, the Chinese might, at certain intervals, take an opportunity to liquidate. Better thing to do than sell your treasuries. Futures prices are running higher. Mm-hmm. Yields are declining. It's always better to do it that way. Jesse Livermore said in you can only really effectively sell into a bull market. If you try and sell in a bear market, you're basically pushing the price down lower than, and it's not really a good idea. So if T-notes are doing what we think they are, and they're in an uptrend, whilst the yield inversely declines as we've depicted here, what better way to liquidate your positioning? If they want to sell treasuries, that's the best way to do it. Favor for them. Slow the decline even down a little bit, but it in yields, that is. But this is probably a very good angle from Chinese if they want to do that.
Right. So here, the only thing we didn't really, I guess, touch on yet is this idea of inflation. There's talk of this one-time price adjustment based on, the tariffs. That to me seems overly simplistic, maybe. So what is the inflation picture as you see it?
Well, we've seen core CPI levels flatline towards the back end of last year. And that's basically in the US, but also elsewhere. I mean, the biggest inflation run-up that we've seen just recently, though, is actually coming out from Japan. We know Japan is a little bit behind the curve. I've got a Japanese chart here. Let me just get that. Here it is here. I hope you can see that, everyone. This is Japan's inflation looks like, and you can see it's starting to accelerate. If you did a comparative overlay with the US, about 2.4%, it's chugging along sideways, but it's doing much the same thing. Since the declines in 22-23, most of the global CPI levels are flatlined and are starting to tick up, and that's why the markets are getting very nervous about, well, certainly the Fed and Powell in particular is very nervous about cutting rates at the moment, because they're looking at these and they're thinking, well, if a tariff war was to exacerbate, that would be inflationary. I think everybody agrees that it would be inflationary, and CPI levels are already ticking up. But to be honest, I don't really see that in the 10-year Treasury yields. I think we would have seen that already. Japan is a slightly different prospect, because we know that they're very, very late in terms of starting to policy. I mean, they've been basically loosening since the early part of last year, and it's only then that they started to consider raising rates for the first time in a long while. And the JGB yields, are still very, very historically low. I mean, if you take a look at this chart, which is a very long-term chart, I think we've got long-term data going back to the 1940s here. This is the JGB yield. What's interesting about this chart is you've got a major high in 1961, whereas most Western interest rate markets sort of topped out in 1981, which is basically Japan was already sort of declining very large, and it's got a long way to go. It's got a long way to go. But CPI and inflation in the US, I don't think it's ready to start getting going yet because of the way in which the Treasury yields are working. Here's a weekly look at the 10-year Treasury yields. This is the entire movement up 5 waves from the pandemic lows, the all-time lows. And generally speaking, even if we put an overlay of fib time ratios on this, we need something like the beginning of next year to finish a correction. This is just basically taking a 61.8 extension ratio of the initial uptrend. And technically speaking, we're still relatively near the highs, compared to where we should be going in order to correct this uptrend. We should be coming down lower. So I don't think that CPI is going to be, personally, I don't think CPI is going to be a factor to signal any revised inflation targets at the moment. I think they will just flatline or weaken slightly here and there until such time that the Treasuries hit bottom. Then, of course, later it will take off. And there's going to be an equitable, this advance here will be repeated here. And it will go a lot higher. And in fact, if we're doing this properly, it's measured something like this, add it to here, and you're probably going to end up at the end of the decade somewhere around this price level, around 7.3%. So that's a bit of a longer term look, interest rates. But I don't think that CPI is a threat at the moment. I think CPI will start to go through its next cycle like this later. But I think Treasury yields will have to drop down here first. They'll have to get at least to 3% and maybe to 270 before we get the next, what I call the last phase of the inflation pop.
Right.
And this movement up here will coincide with the last phase of commodity price increases. And if you want to look at what oil would look like under the final phase of the inflation pop, crude oil will to something like $200. So it's currently in a regression from the March 2022 low at the moment, but at some stage later, oil's going to pop like that. And that movement up coincide with interest rates going up as well. So that's when CPI takes its next big flip to the upside, but it's not quite ready yet, I don't think.
So, that was I guess the last piece that we have to look at was energy prices as well, and we have further to the downside to go, it looks like here.
Well, this chart was updated a few months ago, so it's a monthly chart, and we had, in fact, last 2 years we've had a target at 48.37. I've opened up the discussion recently whether or not the sell-off to $55 was that low. See it actually in our daily chart here, where $55 was a very important low. But I'm still inclined to think that we can get one more push to the downside. It won't happen immediately. I think we've got 2 or 3 months of rallies up to $77 first before we come down again. I think we should come down. Chance of getting sub $50 on crude oil. I'm watching how this is going to play itself out alongside things like copper, and of course looking at the commodity currencies, especially Canadian dollar and those Norwegian kroner as well, which are oil sensitive. Mm-hmm. But I suspect that we might still come down a lot more because, in retrospect, when you take a look at the way that prices ran up from the pandemic low, from 650 up here, this is still a very meager corrective process. It's very small in percentage terms. Actually, it's a bit unfair. We analyze the correction down in relative terms to crude oil, because we probably should actually switch to Brent oil, because Brent oil didn't see this extreme single price of $650. Mm-hmm. And that was being exaggerated by this long position at the time, which had to go into a liquidation to avoid taking delivery. But if we go to Brent oil and look at the same chart, we were at $16 here. And in relative terms, we can see an equitable correction there. This one looks as if it could have completed already. We had a target a couple of years ago at 53.97. During that sell-off the week before last, we got to 58.40. Okay, it's still $4.50 away. So basically, that's nothing in the overall decline from 139. It's possible, but at the moment, for our clients, we're recommending to go oil because we're taking the play up. If it has bottomed in a major way, we'll soon know about it, because this movement up, Brent and in crude, in WTI crude, that will develop into 5 waves. If it's a correction, it will develop up in 3. As this shows. So we've got mechanisms from which we can recognize that, and we cover that in our bi-weekly reports. We have 2 short-term updates going through. Most of the contracts that we've discussed today, actually, that's published twice a week. And if anybody wants to clue in on that, it's the Elliott Wave Compass report, and you can find that on our website. Yeah.
Well, Peter, I really appreciate you taking this really thorough examination of how you see and analyze these markets. And of course, all of your stuff, like that report you just mentioned, is all available at wavetrack.com. Is there anything that you'd like to leave our listeners with to think about before we wrap up here?
Well, I would just say that the one thing that we're trying to put together with the Elliott Wave process and the specific way in which prices adhere to the Fibonacci sequence is that this is a much better guide than being too close to the news flow. If you're already sort of cluing into Trump's social media accounts and following it, you can be a little bit caught up. If you've experienced that, try and pull yourself away. And we'd certainly welcome you to subscribe to the Elliott Wave Compass report twice a week. We try and put in rather more practical look at the way in which the price levels of whatever contracts that you're trading are interjecting with the news flow, and rather putting the news flow to the back burner a little bit, and just getting it to flow with the price levels and the wave patterns as they unfold. Because if you get too caught up, you're going to basically be buying at tops and selling at lows, and we certainly want to be doing something in the opposite direction to that to gain success in trading. So, which is of course what we're talking about, really. So it's just an invitation to everybody out there. If you're really looking for some direction, that's a little bit out of the news flow area, which will be a little bit more pragmatic, then please join us. Yeah, certainly like to see you.
Excellent. And of course, all of your stuff is available again, wavetrack.com. Peter, thank you so much for your time today. Really appreciate it.
Thanks a lot, Tom. Appreciate it too.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.